Okay, so you want to buy a bank. Most people imagine walking into a towering headquarters in New York, stepping into a polished executive boardroom, and somehow becoming the owner of a giant vault overflowing with cash. It sounds simple enough. Buy the building, hire the bankers, collect the interest, and watch the money roll in. But that picture couldn't be further from reality. The strange truth is that the vault is one of the least important parts of the entire business. In fact, if every dollar inside the vault stayed there, your bank would slowly become a very expensive failure. The real business begins the moment money refuses to sit still. That is the first paradox of owning a bank. People believe banks exist to hold money safely. In reality, banks exist to move money continuously through the economy. Every deposit, every payment, every mortgage, every business loan, every credit card transaction becomes part of a financial machine that never truly stops operating. The money is constantly flowing from one person to another, from one company to another, from one opportunity to the next. Your job as the owner is not to protect stacks of cash. Your job is to manage the movement of trust. And trust turns out to be one of the most valuable assets on earth. Think about it for a moment. Every morning, millions of Americans receive paychecks through direct deposit without ever wondering where the money traveled overnight. Families swipe debit cards for groceries. Businesses wire millions of dollars to suppliers. Investors move capital across continents in seconds. None of these people ever see the invisible machinery working beneath those transactions. They simply assume the system will work because it always has. That assumption is worth billions of dollars every single day. A bank doesn't manufacture cars, refine oil, or build skyscrapers. It manufactures confidence. The moment customers believe their money will be available tomorrow, they allow the bank to put that money to work today. That single relationship changes everything. Suddenly, your bank is no longer a warehouse for cash. It becomes a traffic controller directing capital across the entire economy. Every dollar deposited creates another decision. Should it finance a family's first home? Should it help a local business expand into a second location? Should it support a manufacturer purchasing new equipment? Should it remain available to satisfy tomorrow's withdrawals? Every choice carries opportunity, risk, regulation, and responsibility. That's why the world's largest banks don't measure success by the amount of money sitting inside their buildings. They measure how effectively they can allocate capital while maintaining the confidence of millions of people who may never meet each other but unknowingly depend on the same financial system. The remarkable part is that this entire machine operates almost invisibly. Customers believe they're buying safety. Borrowers believe they're buying access to money. Investors believe they're buying financial returns. But underneath all of those expectations sits a far more powerful business than most people ever imagine. Because if money isn't the product, and the building isn't the business, then what exactly are you buying when you buy a bank? The answer begins with something surprisingly ordinary. A customer walks into a branch on a Friday afternoon and deposits $1,000 into a checking account. From the customer's perspective, nothing extraordinary has happened. The money is safe. It can be withdrawn next week, next month, or even tomorrow morning. But from your perspective as the owner, that same $1,000 has just entered a completely different world. It has become raw material. The deposit is not the finish line. It is the starting point of an economic engine that quietly repeats itself millions of times every single day. Of course, you cannot simply lend every dollar that arrives. Customers expect immediate access to their money, regulators require substantial liquidity, and unexpected events can change withdrawal patterns overnight. A portion remains available. Another portion becomes reserves. Only after satisfying those obligations does the real business begin. Somewhere across town, a family wants to buy its first home. A manufacturing company needs new equipment to expand production. A restaurant owner wants to renovate a location before the holiday season. A medical practice plans to hire additional staff. None of them care where the money originally came from. They only know they need access to capital today instead of waiting years to save it themselves. That is where your institution quietly connects two completely different groups of people who may never meet. One group has excess money today. The other group needs money today. The bank stands in the middle, transforming savings into opportunity. But this transformation comes with a price, and that price is where the business truly begins to reveal itself. Imagine your deposit costs the bank a small amount in interest or operating expenses. The mortgage issued to a homeowner generates a higher return over many years. The difference between those two numbers becomes one of the most important financial engines ever created. It sounds almost too simple. Borrow at one rate. Lend at another. Keep the spread. Yet beneath that simple equation lies an extraordinary amount of analysis, technology, regulation, forecasting, and risk management. Every loan represents a prediction about the future. Will the borrower continue earning income? Will the business remain profitable? Will the property retain its value? Will economic conditions remain stable enough for payments to continue? Every approval becomes an exercise in probability rather than certainty. Make too many poor decisions and losses begin to consume the income generated by healthy loans. Become too conservative and customers simply borrow from another institution. Success depends on balancing growth and caution every single day. This balancing act becomes even more remarkable when multiplied across millions of customers. A single regional bank may process millions of transactions every 24 hours, while institutions such as JP Chase move trillions of dollars through payment systems over the course of a year. Behind every digital payment, every debit card purchase, every automatic payroll deposit, and every online transfer, capital continues flowing through an invisible network that most people never stop to consider. The public sees individual accounts. You begin to see circulation. Every dollar enters, moves, earns, returns, and starts the journey again. The deposits create loans. The loans generate interest. The interest strengthens capital. Stronger capital supports additional lending. The cycle repeats continuously, quietly expanding alongside the economy itself. But if this machine appears capable of creating profits almost endlessly, an even bigger question begins to emerge. If the formula seems so powerful, why is it that building a bank from the ground up is something almost nobody is ever allowed to do? At this point, you might assume that starting your own bank is simply a matter of raising enough money. After all, entrepreneurs launch technology companies every year. Investors build factories, hotels, and shopping centers. If someone can afford a billion-dollar skyscraper, why not simply build a bank beside it? Because unlike almost every other business, banking is not defined by the building you own. It is defined by the permission you receive. Before a single customer deposits $1, before a single mortgage is approved, before a single debit card is issued, your institution must convince regulators that it deserves something extraordinarily rare, the public's trust. That trust is not granted with a handshake. It is earned through years of preparation, detailed examinations, legal approvals, financial disclosures, and capital commitments that can easily reach hundreds of millions of dollars before the business even begins operating. Regulators are not evaluating whether you can make money. They are evaluating whether you can survive losing it. That difference changes everything. Imagine opening a restaurant. If the restaurant fails, customers simply eat somewhere else. Imagine opening a clothing store. If sales disappoint, another retailer fills the empty space. But when a bank struggles, families worry about their savings, businesses worry about payroll, and entire communities can begin questioning the stability of the financial system itself. The consequences extend far beyond shareholders. That is why banking has become one of the most heavily supervised industries in the world. In the United States, institutions operate within a framework shaped by organizations such as the Federal Reserve, the Federal Deposit Insurance Corporation, and the Office of the Comptroller of the Currency. Each expects continuous reporting, ongoing examinations, strict capital standards, cybersecurity protections, anti-money laundering controls, consumer protection programs, and sophisticated risk management systems. None of those requirements directly generate revenue. Yet every one of them is essential to keeping the doors open. Then comes the challenge that most people never see. Technology. Customers expect every balance to update instantly. Debit cards must work whether someone buys coffee in Dallas or books a hotel in Miami. Mobile deposits, wire transfers, fraud detection, online banking, digital wallets, automated payments, and 24-hour account access have quietly become basic expectations rather than premium services. Behind each tap on a smartphone sits an enormous infrastructure of secure servers, payment networks, encryption systems, software engineers, compliance specialists, and operations teams working every hour of every day. Building that infrastructure from scratch would overwhelm most companies long before they welcome their first customer. And even after solving the technology problem, another obstacle remains even more difficult to purchase. Reputation. A new customer cannot immediately measure the quality of your risk models or your internal controls. They judge something much simpler. Do they believe their paycheck will still be there tomorrow morning? That question determines whether deposits arrive at all. Trust attracts deposits. Deposits support lending. Lending generates earnings. Earnings strengthen capital. Stronger capital reinforces trust. The cycle feeds itself, but only after confidence exists in the first place. That is why many of the largest financial institutions have spent decades, and sometimes more than a century, building relationships that cannot simply be replicated with money alone. The real barrier to entry is not the cost of constructing another office tower. It is convincing millions of strangers to voluntarily place their financial future inside a system you promise will still be standing years from now. And once you finally earn that confidence, another discovery begins to emerge. The interest earned on loans may power the engine, but it is far from the only business quietly operating beneath the same roof. By now, the bank no longer looks like a single company. It looks more like an entire city operating behind one familiar logo. Lending may generate the headline profits, but once customers begin trusting your institution with their financial lives, entirely new businesses quietly appear around that relationship. Consider what happens after a family opens its first checking account. Soon they request a debit card. Their employer deposits every paycheck directly into that account. They set up automatic payments for utilities, insurance, and streaming services. Eventually they apply for a credit card, finance a vehicle, purchase a home, begin saving for retirement, and perhaps open investment accounts for their children. None of those decisions happen on the same day, yet together they create something far more valuable than a single transaction. They create a long-term financial relationship. Every additional service makes the connection stronger, and every stronger relationship makes it less likely that the customer will leave. That is why many of the largest financial institutions invest enormous resources into convenience rather than simply chasing higher interest rates. Mobile applications become easier to use. Fraud alerts become faster. Customer support becomes more responsive. Digital transfers become almost effortless. None of those features are the final product. They are mechanisms designed to make the customer's financial life increasingly connected to one institution. Once that connection exists, entirely new sources of revenue begin operating in the background. Every time a customer swipes a debit card at a grocery store, payment networks move information in fractions of a second while merchant processing fees flow through an enormous financial ecosystem. Credit cards generate interchange income, interest payments, and partnerships with retailers. Businesses pay for treasury services that help manage payroll, cash flow, and international transactions. Wealth management teams advise families with growing investment portfolios. Large corporations issue bonds, raise capital, and complete acquisitions with the assistance of investment banking divisions. Pension funds require asset custody. Governments issue securities. International companies exchange currencies. What appeared to be one business slowly reveals itself as dozens of specialized businesses connected by the same foundation of trust. This diversification creates another remarkable advantage. During periods when mortgage lending slows, payment activity may remain strong. If business borrowing weakens, wealth management assets may continue growing. Commercial banking, consumer banking, investment services, treasury operations, and payment infrastructure rarely move in perfect synchronization. The larger the institution becomes, the more these different engines begin supporting one another through changing economic conditions. That is one reason organizations such as J.P. Morgan Chase, Bank of America, and Wells Fargo have evolved into financial ecosystems rather than simple lenders. They are no longer selling individual products. They are participating in nearly every stage of money moving through modern life. Yet none of this works without one invisible ingredient. Every service, every payment, every investment account, every mortgage, and every business loan depends on customers believing the institution will continue operating tomorrow exactly as it does today. The products create revenue, but confidence creates the opportunity to offer those products in the first place. Lose that confidence, and every carefully constructed business line begins facing the same problem at exactly the same time. The larger the machine becomes, the more extraordinary its earning power appears. But its greatest strength also begins to reveal its greatest vulnerability. The entire system now appears remarkably efficient. Deposits become loans. Loans generate income. Additional financial services deepen customer relationships. Technology keeps everything connected. Trust keeps everything moving. Looking from the outside, it almost resembles a machine that cannot stop producing value. But that impression hides the most important rule in banking. Every decision inside this institution is ultimately a decision about risk. Profit is simply the reward for managing uncertainty better than everyone else. Imagine two customers walking into the same branch on the same morning. One has decades of stable income, a strong credit history, and modest debt. The other has an exciting business idea with enormous potential but unpredictable cash flow. Both need financing. Both believe in their future. Yet only one may receive the loan immediately. That difference is not based on optimism. It is based on probability. Every loan officer, every credit analyst, every risk committee is quietly asking the same question. What are the chances this money comes back exactly as promised? Multiply that single question across millions of borrowers and you begin to understand what truly separates successful banks from unsuccessful ones. The business is not about saying yes to every opportunity. It is about identifying which opportunities deserve capital and which ones quietly threaten the entire institution. This discipline becomes even more important as economic conditions change. During periods of strong growth, confidence spreads quickly. Consumers spend more freely. Businesses expand operations. Home values increase. Credit losses often remain low, making lending appear almost effortless. That is precisely when experienced bankers become more cautious rather than less. They understand that favorable conditions never last forever. Loans approved during the most optimistic years must often survive the most difficult ones. Every mortgage may last 30 years. Every commercial loan may outlive multiple economic cycles. Decisions made today continue shaping the balance sheet long after headlines have changed. Then there is another layer most customers never notice. A bank must prepare for events that may never happen at all. Severe recessions. Unexpected shifts in interest rates. Technology failures. Natural disasters. Disrupting local economies. Cybersecurity threats. Sudden changes in financial markets. Capital reserves, liquidity planning, stress testing, and contingency strategies exist because uncertainty cannot be eliminated. It can only be managed. This constant preparation creates another paradox. The healthiest banks often appear conservative precisely because they are protecting themselves against futures nobody can accurately predict. Shareholders may wish for faster growth. Customers may want easier approvals. Competitors may temporarily expand more aggressively. Yet surviving decade after decade usually belongs to institutions willing to sacrifice short-term excitement for long-term resilience. That philosophy explains why the world's largest financial organizations employ thousands of specialists whose primary responsibility is preventing problems rather than creating revenue. Risk managers, compliance officers, internal auditors, cybersecurity professionals, economists, and legal teams rarely appear in advertisements, but together they protect the foundation supporting every profitable business line. In many ways, the institution succeeds not because every loan performs perfectly, but because no single mistake is allowed to threaten the entire system. That discipline has allowed some banks to operate continuously through generations of technological change, shifting regulations, and changing economies. But despite every safeguard, every model, every reserve, and every carefully written policy, one fragile element remains completely outside your direct control. The confidence of millions of people can take decades to build, yet under the wrong circumstances, it can begin changing far faster than any financial model can predict. Confidence is one of the few assets that cannot be manufactured on demand. It grows slowly through years of consistent performance, yet it can begin changing almost instantly when uncertainty enters the conversation. Imagine arriving at your office on an ordinary Monday morning. The balance sheet still appears healthy. Thousands of customers continue making purchases with their debit cards. Businesses are processing payroll exactly as they did last week. Mortgage payments continue arriving. Nothing inside the bank seems dramatically different. Then a rumor begins spreading online. It does not have to be entirely true to become influential. Customers start asking questions. A few decide to transfer part of their savings elsewhere, simply to be cautious. More people notice those transfers and begin making the same decision. Individually, every customer behaves rationally. Together, they create something no financial institution can completely ignore. This is the hidden paradox of banking. Your assets may remain valuable over the long term, but your customers can request access to their deposits immediately. A 30-year mortgage cannot suddenly become cash in a single afternoon. A commercial loan financing a manufacturing facility continues generating payments over many years. Yet deposits are designed to remain available whenever customers need them. That difference between long-term assets and immediate obligations is carefully managed every day through liquidity planning, capital reserves, and diversified funding sources. Most of the time, the system functions exactly as intended. But when confidence begins moving faster than capital itself, every decision becomes more difficult. That is why experienced bankers spend so much time preparing for events they hope never occur. Liquidity is maintained not because it produces the highest return, but because flexibility has enormous value during uncertainty. Capital is preserved not because investors enjoy seeing unused resources, but because resilience allows the institution to continue serving customers even when conditions become challenging. Diversification matters because different industries, regions, and borrowers rarely experience the same pressures simultaneously. The objective is never to eliminate risk completely. That would also eliminate opportunity. The objective is to ensure that no single event can overwhelm the entire system. Modern technology has added another fascinating dimension to this challenge. Decades ago, customers often visited local branches to withdraw cash or speak with employees. Today, transfers can be initiated from a smartphone within seconds. Information travels instantly. So does confidence. Banks have responded by investing billions of dollars in cybersecurity, fraud monitoring, real-time payment infrastructure, and continuous operational resilience. Teams monitor networks every hour of every day, not only to protect customer accounts but to preserve the trust that keeps the financial machine operating. Ironically, many of the most important investments inside a successful bank never appear on a customer's monthly statement. They exist quietly in the background, preventing disruptions that customers may never even realize were avoided. In many ways, the institution resembles a bridge carrying millions of travelers every day. Most people never think about the engineers inspecting the structure beneath them. They simply expect the crossing to remain safe every time they drive across it. Banking works much the same way. Customers rarely celebrate stability because stability feels ordinary. Yet maintaining that ordinary experience requires extraordinary discipline behind the scenes. And once you begin viewing the institution through that lens, one final realization starts to emerge. The greatest asset you purchased was never the money, the branches, or even the technology. It was something far less visible, and far more valuable than almost anyone realizes. Now the picture is finally complete. You did not purchase a building filled with money. You purchased a system that quietly coordinates the financial decisions of millions of people who will probably never know your name. Every morning, someone receives a paycheck. Someone buys breakfast with a debit card. A small business pays employees. A family makes a mortgage payment. A retiree transfers savings into an investment account. A manufacturer finances new equipment. Individually, these moments seem ordinary. Together, they become one of the largest continuous flows of capital ever created. The remarkable part is that none of these participants wake up intending to strengthen your institution. They simply want convenience, security, and access. Yet every choice they make reinforces the same invisible network. Customers leave their money because they trust the system. Businesses borrow because they believe expansion today is more valuable than waiting tomorrow. Merchants accept electronic payments because speed has become essential. Employers rely on direct deposits because efficiency has replaced paper checks. Governments issue bonds through financial markets. Central banks influence liquidity through monetary policy. Payment networks connect merchants, consumers, and financial institutions across the country. Every participant solves an individual problem, but together they keep the entire machine operating. That is the hidden advantage of owning a bank. You are not convincing millions of people to support your business directly. You are providing infrastructure they naturally depend upon while living their everyday lives. The more reliable that infrastructure becomes, the less people think about it. Ironically, invisibility is often a sign of success. Electricity works because nobody notices it until the lights go out. Highways succeed because drivers rarely think about the engineering beneath the pavement. Banking follows the same pattern. The smoother the experience becomes, the more ordinary it feels. Behind that ordinary experience, however, every relationship compounds over time. A college student opening a first checking account may eventually become a homeowner, a business owner, an investor, and later a retiree. One relationship quietly expands across decades. Multiply the journey by millions of customers and the institution gradually transforms into something much larger than a lender. It becomes part of the economic memory of entire communities. This is why long-established banks often place enormous value on customer retention rather than chasing every short-term opportunity. Time itself becomes an asset. The longer trust survives, the more opportunities naturally emerge without aggressive persuasion. Yet there is another reason this system has endured for generations. Every participant benefits in a different way. Depositors receive security and liquidity. Borrowers gain immediate access to capital. Businesses finance growth. Investors allocate wealth. Governments support economic activity. Payment systems enable commerce. Employees earn careers maintaining the infrastructure. Even competitors help strengthen confidence by contributing to a stable financial ecosystem. The institution succeeds because it continuously creates value for multiple participants at the same time. That balance is extraordinarily difficult to design and even more difficult to preserve. Which brings us back to the question that seems so simple at the very beginning. If the true business was never storing money, if the greatest asset was never the vault, and if the entire system ultimately depends on trust flowing through millions of daily decisions, then perhaps owning a bank has never really been about owning money at all. It has always been about owning one of the world's most important systems for moving confidence through an economy. After everything you have seen, one final paradox remains. The stronger a bank becomes, the more invisible its real product appears. People never walk into a branch asking to purchase trust. They ask for a checking account, a mortgage, a business loan, or a credit card. Yet every one of those services is simply another expression of the same invisible asset. Trust allows deposits to arrive. Deposits create liquidity. Liquidity supports lending. Lending finances homes, businesses, infrastructure, and innovation. The repayments strengthen capital. Stronger capital reinforces confidence. Confidence attracts new customers. The cycle continues, quietly expanding year after year. This is why ownership of a successful bank is fundamentally different from ownership of almost any other business. A retailer depends on selling another product tomorrow. A manufacturer depends on producing another machine next month. A hotel depends on filling another room tonight. A bank depends on preserving a relationship that may last for generations. Consider a family that opens its first account while saving for a first apartment. Years later, they finance a home. Later still, they open college savings accounts for their children. Eventually, they begin planning for retirement, managing investments, and transferring wealth to the next generation. What appears to be dozens of separate financial products is actually one continuous relationship extending across an entire lifetime. Multiply the journey by millions of households and the institution gradually becomes woven into the economic fabric of an entire country. That long horizon changes how successful owners think. Quarterly earnings matter. Annual growth matters. But survival matters even more. The greatest financial institutions in history did not become influential because they experienced one extraordinary year. They became influential because they continued serving customers through changing interest rates, shifting technologies, recessions, recoveries, and entirely new generations of consumers. Their competitive advantage was never simply scale. It was continuity. Every decade they remained dependable made the next decade easier to build. That continuity also explains why banks invest heavily in systems most customers never notice. Cybersecurity protects confidence. Compliance protects legitimacy. Payment infrastructure protects reliability. Employee training protects consistency. Risk management protects resilience. None of these activities produce dramatic headlines on their own, yet together they preserve the foundation supporting every visible service. Remove enough of them, and even the most impressive balance sheet begins losing its value. This is where the ownership perspective changes completely. At the beginning, it seemed reasonable to believe you were purchasing an institution that handled money. Now it becomes clear that money is only the medium flowing through something much larger. What you actually own is an invisible infrastructure connecting households, businesses, governments, investors, payment networks, and financial markets into one continuously operating system. Every successful transaction quietly reinforces that network. Every satisfied customer strengthens it. Every responsible lending decision extends its future. Every careful risk assessment protects its stability. The institution grows because millions of ordinary decisions continue pointing in the same direction. And that brings us to the final question. If the true value of a bank has never been the cash inside its vaults, and if its greatest competitive advantage has always been the confidence flowing through an invisible network of relationships, then what does it really mean to own one of the most powerful financial institutions in the world? Now we can finally answer the question that started this entire journey. You never bought a building. You never bought a vault. You never even bought money. You bought the legal authority, the operational capability, and the public confidence required to move capital through an economy every hour of every day. That is what makes a bank one of the most unusual assets ever created. Nearly every business creates value by producing something tangible or delivering a visible service. A bank creates value by connecting time. One customer has money today but does not need to spend it immediately. Another customer needs money today but will earn it over many years. Your institution stands between those two moments, transforming idle savings into productive investment while carefully managing the risks that exist in between. Every mortgage financing a family's home, every commercial loan expanding a local business, every payment settling between companies, every retirement account preparing for the future represents another example of time being reorganized into economic activity. That is why banks occupy such a unique position in modern society. They do not simply participate in the economy. They help coordinate it. The irony is that the better this system works, the less people notice it. Customers rarely think about payment rails when buying groceries. Business owners rarely think about liquidity management while approving payroll. Families rarely think about capital allocation when making a monthly mortgage payment. The infrastructure succeeds precisely because it becomes ordinary. Yet beneath that ordinary experience, millions of financial decisions are being synchronized every minute through institutions that must balance profitability, regulation, technology, and trust simultaneously. This also explains why banking remains one of the most difficult industries to enter and one of the most valuable to operate successfully. The barriers are not designed to protect profits alone. They exist because every decision inside the institution can influence households, businesses, and entire communities. The privilege of moving other people's money carries an equally significant responsibility to preserve confidence in the system itself. That responsibility never disappears, regardless of economic conditions or technological change. New payment platforms will emerge. Artificial intelligence will reshape financial services. Digital banking will continue replacing physical branches. New competitors will challenge traditional institutions. Yet the fundamental mission remains remarkably unchanged. Someone will always need a safe place to store value. Someone else will always need access to capital before they can create more value themselves. As long as those two realities exist, institutions capable of connecting them responsibly will continue playing a central role in economic life. Which brings us back to the paradox that appeared at the very beginning. People believe banks exist to hold money. In reality, money is only passing through. The true asset has always been trust. Trust allows deposits to arrive. Trust allows lending to continue. Trust allows payment systems to function. Trust allows economies to grow. Remove the trust, and the entire machine slows. Preserve the trust, and capital continues moving, businesses continue expanding, families continue building their futures, and the financial system quietly performs one of the most important jobs in the modern world. In the end, owning a bank is not about possessing the largest pile of money. It is about stewarding one of the world's most powerful networks of confidence, where every dollar is simply the visible expression of something far more valuable that cannot be locked inside any vault.